The most cutest standard in our syllabus, accounting standard 27, which deals with investment in joint venture. So under this method, we do consolidation, but the consolidation here is proportionate consolidation. And joint control or joint venture starts when you don't have control over the entity alone. There is somebody else also has control over it. So you have slightly more than significant influence, but you are not the only one who has control. So then it becomes a joint venture. For instance, I hold 50% and you hold 50%. Together we hold 50-50. I don't have alone control and I can't call it influence. I have more than influence, but I have slightly lesser than unanimous control. That becomes joint control. In this case, how do I consolidate that joint ventures assets and liabilities into my consolidated balance sheet? That is what we learn in accounting standard 27. This case may will divide the particulars into three categories. One, jointly controlled operations. Two, jointly controlled assets. Three, jointly controlled entities. Let's start with jointly controlled entities. I am A Limited, you are B Limited. Together we form a new company called C Limited. In C Limited, I hold 50%, you hold 50%. That C Limited is jointly controlled entity. The assets and liabilities of jointly controlled entity C along with its share capital will be proportionately divided between A and B. Line by line, each item 50% will be added to each other's assets, liabilities, and capital. That is jointly controlled entity. Jointly controlled asset is there is no separate entity created. I am A, you are B. We together buy one asset. That asset is registered in both of our name together. I get to use that asset for some days. You get to use that asset for some days. Whatever repair expenditure, maintenance expenditure, insurance expenditure, depreciation which is there on that asset, we will share it. All of this will happen at one agreed ratio. And that asset, that expense, that depreciation, everything will be proportionately divided between both the joint venturers, co-venturers, and it will be written in their P&L and balance sheet. Then comes jointly controlled operations. It is an arrangement between two or more venturers who combine to bring in their operations, resources, and expertise. For example, for construction of a building, I will put land, you will put building material, someone else put labors, all three of us together will build the building. And in that building, we'll divide the number of flats that each of us gets. That is this jointly controlled entity. Sorry, jointly controlled operations. In that jointly controlled operations, I will not include that joint ventures transactions in my books. I will record my transactions in my books. You will record your transactions in your books. If you make any payment to joint venture, you will write it as receivable from joint venture. And at the end, in the joint venture, we write all the expenses, all the incomes. There is no going concern. Determine profit or loss. That profit will be shared to all the co-venturers. I'll record that profit receivable. There is no separate entity actually. So whatever receivable I have from the joint venture is from the other co-venturer. If I have a receivable, to the same extent you will have payable. If there are three co-venturers, if one has receivable, then other two together will have same amount as payable. Can be in different ratio. Depends upon what they've got to the table. Depends upon what they've taken from the table. Very simple standard. So far, there hasn't been a question on this standard ever in your CA intermediate. But remember to practice those 3-4 questions what is there in the study material. Too easy to do. And that's accounting standard 27 joint venture.